January 1st of 2013, it might cost you more to sell your real estate because there's a new 3.8% Medicare tax associated with the new health care law that President Obama approved. And not only is this new tax controversial, it's widely misunderstood. So to answer some question about it, Wink News real estate expert Denny in with us this morning. This does sound like it could be somewhat complicated. Hopefully you can make it easy for us.
It is. I can tell you what, it'd be a whole lot easier explaining the birds and the bees to your adolescent than explaining this tax law in 3 minutes, but we'll give it a shot.
All right.
The best way to do this, let me walk the audience through a couple slides to make it real simple, okay? First slide is basically going to talk about what the new tax is. And it's based on the qualified. And again, the good news for folks in this area is only going to apply to about 3% of the folks. You need to have adjusted gross income of greater than $200,000 an individual or $250,000. If you don't, it doesn't apply.
Forget about it right off the top.
And again, this tax applies to many other things other than real estate, but I'm only going to talk about real estate. Okay, the second slide talks about the 3.8, and the formula is based on the lesser of the gain of the sale of a property or how much that sale has increased your income over the limits we just talked about. The important thing to remember, and this is what the biggest mistake is, it is not a tax, it's not a sales tax. It does not apply to every real estate transaction. It only applies if you meet certain thresholds. And so, like I said, it won't apply to most people. The number one concern people have, and the next slide goes through kind of a little scenario, Rob, of selling your primary home.
Make it understandable.
Yeah, this is a good example. And again, it's kind of funny. In this example, we got a husband and wife that sell their home and have a gain of $525,000. There's not many people in our marketplace that have that kind of gain on their home, but it could happen. Now remember, there is a capital gain exemption on your primary residence for a couple, $250,000, you get that exemption of $500,000. So what they're showing here is a couple has $325,000 of adjusted gross income. There's $525,000 gain on the sale. So the taxable gain is only $25,000 because of the subtract the exemption.
Right.
So your new adjusted gross income is $350,000. Now you apply the formula. The excess of adjusted gross income over the $250,000 is $100,000. Okay, that's $100,000, and the taxable gain is $25,000. So the tax of 3.8% is applied on the lesser. And so you take the 3.8% times 25,000, they have about $1,000 in tax.
About $1,000 in tax. This is going to be tough. You're going to need some help to get through some of this if it applies to you.
Yeah, well, the good news is we have a booklet, and you can find one online. It explains a lot of different scenarios. And you just email me, denny@dennygrimes.com. I will send it out to them. But the interesting thing is this was a second home. In the same scenario, the tax would have been $20,000 because you don't get the $500,000 exemption.
Very interesting.
It can be significant.
It can be. And email Denny if you want that book. We'll be right back.